I'm Charlotte McLeod with investingnews.com, and here today with me is Curtis Moore, SVP of Marketing and Corporate Development at Energy Fuels. Thank you so much for being here.
Well, thanks for having me, Charlotte.
Really good to have you here again. Our last conversation was exactly a year ago here at PDAC, and where I thought we could begin is just checking on the uranium market, where we're at in the cycle right now, because it's been a pretty big year.
It has. I'll start off by saying it's a great time to be in the uranium business. This is sort of the moment we've been waiting for. We went through a very long downturn in the price, but all throughout that process, the fundamentals were just still getting stronger and stronger and better. And so finally, here we are, and the price has risen to some very nice levels. These are great levels for us as a uranium producer. We can profitably produce uranium at these levels, and so again, this is something we've been waiting for a long time. Now it's time to capitalize.
I think that's a good way to put it. And with that in mind, with that background, I think it's easy to see why the company decided recently to go back in production at three mines, I believe. So price, of course, is part of that. But I wondered if you could talk about the decision, because I'm sure there's a lot of factors.
Well, look, there's a lot of factors driving markets today, not just supply and demand fundamentals, but geopolitical issues, just increased growth in nuclear energy and increased interest around the world in using nuclear as a solution to climate change. But ultimately, the reason we brought these mines into production was price. These levels that we're seeing right now are levels that we like. Now, look, I think that this could just be the beginning of the cycle. I think there's lots of reasons to believe that the price could go higher. You never know where the top is going to be. We have decided to lock in some of our production, on the order of about 25% of our production so far into long-term contracts. This would be sort of our short-term, low-cost production. But we're still largely unhedged to uranium markets and further growth. Again, we're able to make profitable uranium sales right now. And again, we turned a profit last year. Not too many uranium companies were profitable last year. Our goal is to try to continue that as we move forward. We've produced a lot of uranium over the last several years and inventoried it. We've largely been the only uranium producer in the United States. We've produced about 2/3 of all U.S. uranium over the last 5 or 6 years. And so that's what we're selling into the market right now. And now we're getting these mines going so we can start to deliver that uranium into the market profitably.
Okay, so you've got the 3 mines going. Another 2, I believe, due to come online in a year or so. So I wondered if you could talk about that and just the longer-term plans for production.
Yeah. So what we're focused on is what I term our short-term, fully permitted, fully developed, low-cost portfolio. And so this would get our company up to a level of about 2 million pounds of production per year. And that's from the 3 mines that we're restarting. That's also from these 2 mines that you referenced. That includes our Nichols Ranch in situ recovery project in Wyoming. It also includes our Whirlwind mine, along with our alternate feed recycling and that sort of thing. We'll see where the market is. Assuming markets remain as strong as they are, and hopefully stronger, we'll be putting those next 2 mines into production and hopefully be producing uranium at a run rate of about 2 million pounds per year by next year at some point.
Okay, very, very clear. And I wondered if you could say more about the process of getting these mines up and running, because I think everybody knows you can't just flip a switch. So what can you share about that?
Well, I will say that because we've been largely the only uranium producer in the United States over the last several years, it's enabled us to keep our workforce intact. It's enabled us to keep our projects up in good working order. So no, it's not as easy as just flipping a switch, but it's probably easier for us than for others because we do have a workforce to draw from, and we do have facilities that we've been maintaining and refurbishing and getting them ready for this moment. So again, it takes time to get things going, but I think hopefully it goes smooth for us, and so far it is, and we're excited to.
Right, and you've got a lot going on right now, but I have to ask, would you be looking to acquire new assets at this time?
Look, nothing is ever off the table. Everything is, certainly anything that makes sense. But I would say that the time to buy uranium assets was probably 5, 6, 7 years ago when the price was low. Okay. And so that was the time to position yourself for this moment. And I would argue that today is the time to produce and sell uranium profitably, where the prices are good, right? And so that's what we're focused on. I would say, and I know we'll talk a little bit about our rare earth business, but in that same vein, now is the time to position ourselves in the rare earth business while prices are low anticipating that the market fundamentals will come back and, and we'll be able to produce and sell rare earths at a profitable level. And ultimately, that's what we're trying to do as a company, is create a cash flow positive, high margin, critical mineral company centered on our uranium capabilities. Again, that's enabling us to diversify into some other things. And so again, ultimately, we're looking for positive cash flow.
I think that's kind of what I expected you to say, and it does make complete sense to me. So thanks for going into that part. I wanted to move back to contracts. You mentioned you are mostly unhedged at this point. And I wondered if you could talk about the process of signing contracts, deciding what you're going to do with your production, because I think investors are really starting to focus on that. Now companies are starting to produce, and they want to see that exposure to the spot price. So
yeah, they do. And look, at the end of the day, you never know where the markets are going to be in the future. You never know where the price is going to be. I mean, again, I think there's a million reasons to believe that the price is going to keep going back or going up, but there's no guarantee there, right? And so, again, we focus on profitability and cash flows. Honestly, it's one thing that maybe some uranium companies needed to do during the last cycle is that, you don't probably want to put all of your production into contracts, but you probably want to put enough in there to at least cover your costs, your corporate costs and things like that. So if things do go sideways, you at least are able to tread water and wait for things to come back. And so we're looking at doing that. And so again, we've put about 25% of our production into contracts. Now, I will say that those contracts also have exposure to the spot market. Like for instance, we made a sale under our contracts right at the beginning of Q1 this year, 200,000 pounds. We sold it for about $75 per pound. It was still a 50% margin, as I recall. That was at a time when the spot price was about $90 per pound. So yeah, we don't get full exposure to spot, but that same contract, those contracts we sold last year, I believe the average price was about $56 per pound. So we do have leverage to the spot price under our contracts.
Okay, it's good to go into detail, and it was very interesting for me. Then the other thing I wondered if you could talk about, we hear of utilities as this very opaque part of the market, and I wondered if you could talk about how your conversations have changed as the market has improved.
Well, they're calling me now. Yes, they are. And again, some people ask me, "Oh, are utilities panicking?" I'll say, "No, they're not panicking." Right? They have large assets. A lot of capital goes into building those, and so they're not going to put themselves in a position where they're about to run out of fuel. But they want to make sure that they continue to have that uranium on the long term. And so yes, they're calling me. You'll notice that the long-term price is still only about $75 per pound versus the spot price today is about $94, $95 per pound. But we are seeing that long-term price start to step up toward that spot price where it is right now. And, being able to sign long-term contracts that has a fixed price component that's in the 90s, look, it's good for us. It should be good for others. And again, hopefully things keep going up higher. And again, you want to leave quite a bit of your production unhedged to, if the price goes to $150, $200, $500 per pound, you want to be able to sell into that sort of a market. But on the other hand, it's good to have that long-term high margin cash flow.
Right. And as we talk about the price, I think it's pretty clear it can go substantially higher, but I know that investors are looking at what's going on right now. There's a little bit of consolidation, a little bit of a pullback, very small, but, I think some people are a little bit concerned. So maybe just your thought.
I've heard this and I just have to laugh. If you had told us a year ago that the price was $95 a pound, we'd be jumping for joy. Now people are, oh, boy, I don't know. It just pulled back to 95. It's like, geez, come on. This is a good price. Okay. And yes, and it's also a spot price too. And, very little uranium, relatively speaking, trades on the spot market. There's a lot more volatility there. It's much thinner. It certainly presents great opportunities. For instance, our company, we also sold 100,000 pounds this quarter for an average weighted price of about $103 per pound. So it does, have some nice opportunities to sell there. But like if we had 1 million pounds to try to sell that on the spot market, it might be a little tough. It might drive the price down pretty substantially. But on the other hand, there is a shortage of material in the spot market. So I don't know, it goes back to the point. You want exposure to spot, but you don't want full exposure to spot. At least that's the theory of our company.
Okay. And I think, people are still, though, they are looking for price catalysts, right? And one thing that I have heard coming up is this U.S. potential ban on the Russian imports. And I think that you're probably well positioned to talk about that. So can you share what you see happen?
Well, I mean, look, it is a bipartisan issue. It's not like Democrats or Republicans are in favor or against it. I think there's broad consensus to have that happen. It should have happened long ago. I mean, the atrocities that Russia is committing in Ukraine right now is just it's horrifying. And the fact that we're still spending or sending $500 million to $1 billion per year to Russia for their uranium and nuclear fuel is just personally dismaying to me. But hopefully this ban comes about and we stop sending that money to Russia. And I do think that could be a catalyst for, certainly on the spot market for further price increases. Hopefully it happens soon. We'll see. It's all the the sausage making of the U.S. Congress. So, but it will happen, I think, at some point.
Okay, and so there's some impetus there to produce more uranium from inside the U.S. How are we doing there on conversion and enrichment?
Yeah, those are also obviously pinch points as well. The conversion facility in Illinois is starting up right now, and that's good. There is, as I understand, there's talk of expanding enrichment capacity both in the U.S. and in Europe to try to supplant that Russian enrichment and conversion capacity. I think that Russia has sort of just, they poisoned the well. Certainly U.S. and European utilities are probably going to stay a long, long way away from Russia for a long time. And so there needs to be other production, whether it's uranium mining, conversion, enrichment, fuel fabrication, outside of Russia. And right now, I think the West is rising to the occasion. And ultimately, that means more demand for our stuff. So that, again, is a very positive catalyst for just a uranium miner like us.
Right. So much going on in uranium, but we do have to come back to the rare earths aspects. And, very interesting. We always hear uranium, this is a tough market to understand. It's hard to get details, but rare earths definitely hasn't beat, I think. So I wanted to start by just getting your thoughts on what's going on in the market right now, specifically the part of the market that you're involved.
Yeah, absolutely. Absolutely. Like I said, right now is the time to produce and sell uranium profitably. Right now, with rare earth prices being a little bit depressed right now, we think it's a great time to position ourselves for when those prices ultimately come back. Rare earth prices did do very, very well over the last few years, primarily driven by electric vehicles. But I think that some of the maybe initial projections for adoption of electric vehicles by consumers it's still very strong. Honestly, EV sales were far higher last year even than previous years. They're maybe just not quite as strong as some analysts were thinking they would be, and so that has dropped the price a little bit. And so again, that has presented a great opportunity for us to get involved in some other projects. And so we're focused on this mineral called monazite. We think it's the best way to produce the light rare earths. So what you're primarily going after are the magnet rare earths. That's NdPr and Tb and Dy. Those four. The NdPr are the light of those, the light rare earths of those four. And monazite is a wonderful source for NdPr. Number one, it's just got higher concentrations of that naturally. It's easier to process. And so we've been moving down that road with monazite. It also has heavies in it, just not as many heavy rare earths as some other minerals out there. But we're about to commission a new NdPr circuit, a separation circuit. So that's the solvent extraction process you need to produce high purity NdPr oxide, which is a huge step for us. I mean, it'll have the capacity to produce about 1,000 metric tons of NdPr oxide per year. It'll be one of the largest NdPr circuits outside of China. And even better, we did it way under budget. We put this in our mill for $16 million. And when you hear about rare earth companies looking to spend hundreds of millions or billions of dollars, and we did a little rare earth circuit, enough for 1 million EVs per year, for $16 million, I mean, I hope that opens some eyes. And so we're probably going to produce on the order of 30 or 35 tons of NdPr just to commission it, get it going, make sure it works, optimize it, and then shut it off and focus on uranium, because uranium markets are strong right now. But when that rare earth price comes back, which we think it will, we'll be ready to go.
And, I think every time I speak to you, you seem to have picked up a new source of monazite. And recently you've got an MOU for a project in Australia. So it's looking pretty global. Are you going to be continuing to look for sources? Are they going to be also in these global locations?
Yeah, I mean, what we're doing, and again, this is one of the reasons we think we're going to have an economic advantage over a lot of other rare earth companies out there, is that our source of our feed is a byproduct of other mining. It's a byproduct of titanium mining primarily. And so these are heavy mineral sand projects. and they're primarily going after titanium minerals, ilmenite, rutile, leucoxene, the zircon, zirconium minerals, that kind of thing. And this monazite sand just occurs as a byproduct. And so your cost to produce monazite sand at a mineral sand operation is very low. It's your marginal cost to pull it off and then ship it, because your primary economics are driven by the titanium and zirconium. And so what we've been doing is getting involved in some mineral sand projects with the idea that we'll get the low-cost monazite product, a very low-cost source of feed, possibly even free feed in some instances, which would be an amazing advantage that we have. Our project in Brazil, our Bahia project, which we're advancing right now, we've announced this MOU with the Donald project in Australia, which we're excited about, obviously. Our ultimate goal is to get up to, say, half or 3/4 of a Lynas. So Lynas is the big Australian rare earth producer. They're a great company doing great work in Australia. We're trying to get to maybe half or 2/3 of their size, and so that gives people the idea of the scale of monazite we're looking for.
Yes, that does give a good idea of the scale. It helps make it a much better idea. So rare earths, one more question. I think they're kind of a funny market where it feels like every few years, 4, 5, 3 years, we realize that it's a problem and we should probably be producing them in places outside of China. Do you see, how do you see that developing, I guess is my question. Are we going to get more, on board with that?
Yeah, I think so. There is a real desire by auto manufacturers, for instance, to not be totally dependent on China. China's still going to be the big dog in rare earths for a long, long time. And that's great. I mean, that's fine. They do good work there. But they also see some risk there to being totally dependent on these Chinese sources. So these non-Chinese sources are like ours is starting to develop. I do think that we have got the right plan. A lot of companies have struggled in the rare earth space. It is a very funny market. Like I said, it's even more complicated than uranium. We don't do anything easy at Energy Fuels.
There you go. Yeah.
But we think we have got the right plan for the right time in a very economic way that could be competitive, should be competitive with China. Sort of tier 1 production of the rare earths you need for electric vehicles, wind energy, military and defense, and all that.
Okay, really good to get those updates. And just before I let you go, any final thoughts on either uranium or rare earths that you want to leave investors with?
No, I think we covered it. I mean, again, we're a profitable company. We made $100 million in net income last year, which was a wonderful milestone for the company. We're looking to keep that profitability going in 2024. And at the same time, we're investing those profits into building up this separate sort of standalone business, again, related to uranium. That's what rare earths are. And again, so I've heard people say, oh, we're moving out of the uranium business or something like that, which is silly. It couldn't be farther from the truth. I mean, we're capitalizing on uranium markets by producing and selling it. That's how you make money as a miner. But we're reinvesting those profits into this other very potentially high growth business. And we just think it's a great way to build some shareholder value there.
Okay, very good. We'll leave it there for now. Really good to have you on to talk, though.
Yeah, absolutely. Very good. Well, thanks for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Curtis Moore with Energy Fuels.